The Footprint course, Unit 15, Risk Event Trading. This is challenge day 29 of 30. In the following slide, we're going to focus on one of the most important tools utilized by professional traders, liquidity.
We're going to talk about leverage today, okay? The big L word. Now, the wonderful thing about leverage is it's a term that not many people talk about. People are afraid to talk about leverage. Why? Because look at every advert you see on the CNBC, the Bloombergs, these spread bettors. All of them talk about, risk of loss being more than your initial capital, and leverage is bad, and if you use leverage effectively, you're effectively risking 20-30% of your account on any given trade. So what's being advertised out there is that leverage is a bad thing. Okay, now yes, in terms of the basic essence of portfolio management and sort of making real returns over time, yes, leverage is a dangerous product, but only if you don't understand leverage. Okay, leverage is equally a very powerful product in a sense that leverage allows you to scale up or to take up more risk when the odds are in your favor. Now, if there's one thing you guys can learn from today, it's ultimately that, us as traders, us as professional traders, what we want to do and what we do is we leverage up at a point in time where the probability or the odds are in our favor. Okay, and that's what it's about. Whenever you look at a trade, it's not about the odds of based on statistical analysis. Okay, people always say to me, how do you work out those odds? Right? It's not a case of I have 10,000 samples of a specific trade setup, and I suddenly say, well, the likelihood of the outcome being favorable is 62.5%. It doesn't work like that. Okay, the outcomes are based on various patterns that we develop over time, based on various intuitive price actions we see on the ladder over a period of time. And it's that intuition, that feeling, that confidence, that trust, all of that together equals a probability of an outcome. Okay, so just bear with me when I use that word probability. It's not in the most technical sense. It's not in the sense of, I've backtested 1,000 sample sets. It doesn't work like that. Okay, that's the game left for the algorithms, the statisticians, and the big macro hedge funds that choose to create these algos. Okay, so leverage in the sense of the word. Now, what did I want to talk about in terms of the leverage is obviously the pros. Okay, yes, you can scale up, you can make a lot more money. Yes, you can make better returns over the long run, okay? The important thing when it comes to leverage is to not just understand the positives about it, is to understand the psychology behind leverage, or the cons, okay? So when I talk about this, you'll very often, if you spend a lot of time with me, I always ask myself, I put myself in a situation of, if there was something or a situation I hadn't been in before, what would the psychological implications of that be? Okay, let's use an example. So let's say, for instance, in a futures market, I'm used to using a one lot. Okay, now over a period of time and over a number of trade setups and trade strategies, I'm going to get used to my risk being within a specific range. So let's say I'm used to my risk being between -100 and say -200 on average over a given period of time. Okay, now all of a sudden, I decide I'm going to leverage up and I'm going to go to a 4 lot. Okay, so I'm taking on 4 times the multiple. Now, instinctively, the minute you have a bad trade, this parameter of 100 to 200 is going to move from 400 to 800. Okay, so straight away you can see the psychological impact of being used to being in that sort of a range of a risk, and now you've moved to almost a complete outlier of a risk, something that makes you feel completely uncomfortable, right? There's going to be a psychological impact. Now, it's important to understand that psychological impact, because what I found very early in my career was I really battled with increasing the size because I wasn't willing to accept that natural progression in my risk. All right, so if you can understand and accept that by the very nature of taking on more risk, your downside's equally going to have to look a little bit different and feel a bit different, right? by accepting that in the beginning, from up front, you're going to be able to learn to leverage up a lot easier. Okay, remember guys, you have to take the downside with the potential upside. That's how it works. Ultimately, what it comes down to is, regardless of how much size using, how much levering, it all comes back to the same process. Okay, whether you're taking on, let's get an example here. So whether you're taking on, let's say, a breakout trade, okay, whether you're taking that on with a 1 lot or a 4 lot is completely irrelevant, right? There is no change to the process. Why? Because the market will take you on a 1 lot or a 4 lot. There's enough liquidity, again, depending on the market you're trading. Okay, so there's no significant difference in the process to trading a 1 lot or a 4 lot. Right? It's just understanding the psychology behind what it means to actually leverage up. Okay, now, important. A lot of you are going to say, yes, but when is the right time to use leverage, or my account can't necessarily handle the leverage? Yes, that is a fact. Okay, it's something I had to accept. So earlier in my career, let's say I had a £5,000 in my trading account. Okay, and I wanted to now progress to maybe a 5 or a 6 or an 8 lot. Now, of course, yes, I have to accept that I might lose, say, £1,500. Okay, that's a significant amount of my account, right? So what we would typically do as traders, and again, what I want you to take away from today is I want to encourage you guys to learn a little bit about leverage through understanding it. Okay, now one of the things we used to do a lot was when we struggled to get our clip up, we would say to ourselves, okay, if I have a good day, so let's say I make €1,000 today, whatever, and my account goes to 6,000, then I'm going to move my clip up, or I'm going to leverage up by a marginal amount. So I'm going to go from trading, say, a 5 lot to a 6 lot that day. And then if I had another green day, say to 6,400, I would then say, okay, I'm going to push it to a 7 lot. And slowly but surely, I got used to the fact that, psychologically I was taking on more risk. Okay, but I was doing it, I was doing it in a positive run. Okay, the biggest mistake new traders make, I made, most traders make when it comes to leverage, is they tend to use leverage when they're wrong, when they're offside, when they've lost control of a trade. And that's why that psychological damage sits with them for the rest of their careers, because they always seem to associate that blowout, in their account, or that blowout moment to leverage. Okay, it's got nothing to do with that. Right? It was the wrong use of leverage that created it. Okay, so if you've had that moment, if you've had that experience, try and associate. Learn to use leverage when you're on a good run, and do it incrementally. You take those 2 tips of advice, guys, and you're going to finally start, understanding the use of leverage. Okay, so let's come back to that old question, and this is where we're going to wrap up on leverage. Where do professional traders use leverage? Okay, well, it's very simple. Let's say we take, for example, a lot of you guys follow us in the morning streams, and we can talk about, we're going to talk 2 examples, okay? Now, let's take the Bund example for this morning, all right? Someone asked about the Bund, the question was there, what was it that gave us the inclination that the Bund was going to go lower, okay? Well, there just happened to be a wedge. Now, I'm actually going to get that up for you so that we can actually just look at it together. All right, so there's the wedge. You can see it nice and pretty on your screens. We've been sort of sitting in this wedge for the last couple of days, almost a week now. And okay, we can see that all of a sudden this morning, we came and we tested that wedge outside of the cash house. Okay, so now we have a trade set up. We have an opportunity. The market is showing us a technical pattern, and we would like to take advantage of this pattern. Now that in its own, and now I want you guys to I want to almost bring you inside my mind, okay? That in its own does not necessarily imply I'm going to use leverage, okay? So what happened in this situation was the market broke, it filtered down, we got a very big pickup in the volume. Okay, so where would we use leverage in this example, all right? Some traders, and what I'm going to need to do now is I'm going to need to zoom you in onto an even shorter term time frame. So I'm just going to bring up the oh, I don't have it, yeah. Okay. I was hoping to bring up the 1 minute chart. But if you go back and you look at this, okay, once we took out that initial balance low, so I'm going to draw it over here. Once we took out the initial balance low, right, after the cash opened, the market then sat for almost 20 minutes churning sideways. Okay. And within that churn, within that sideways trade, once we had broken down below the key base trend line or support line or whatever you want to call it, once we'd broken below that and started to accumulate, that is when traders employed their leverage. That is when traders got involved. Why? And this is the clue. The art to leverage, guys, the art to trading is knowing the risk. Okay, the minute you know the risk on any trade, it doesn't matter what you want to call it. The minute you know that risk, you have got a very powerful trade. Okay, so the risk in this trade is very simple. Right above that initial balance low, which coincided with that break of that support. That is where the trade was invalid. That is where the trade was gone and no longer worth being in. So as long as we were below the break and accumulating sideways, traders were then leveraging up, getting stuck in that sideways range, and once it then finally took up the bottom end of that downward range, we got the aggressive 10, 15 tick down move. That was the play from this morning. That was how we incorporated leverage. Okay, now let's say for all intents and purposes, let's say it didn't go down in the manner that it did. So let's say it did this instead. Let's say it broke, had maybe a 2-tick pullback, and then broke again, very aggressively. Okay, it's very, very unlikely that many traders would have employed leverage. Why? Because when you employ leverage, one, you are taking on more risk. Okay, so you need more confidence, you need more understanding of the trade you're going to take on. Okay, so when there are less variables to lean on, when there's less information to lean on, when there's less probability of an outcome occurring, that is when you don't want as much leverage. Okay, it comes back to that whole question of when do we use leverage? Well, it's simple. When we have good understanding, we know the risk, we're confident, we trust what we're doing, and we want to get aggressive because the probability of an outcome is high. That is leverage, guys, used in an example. Okay, now that's our Bund example for this morning. I hope you guys understood now, not just how we got into it, okay, why we got into it, how we would have executed, where the stop was, where the target was. Okay, again, that's a very personal thing. I never talk about targets because, what is the point about talking about a target? One person might feel that, he wants to take 5 ticks because, he knows there's a 90% chance of that happening. Some trader might prefer to have a smaller size and run it for a bigger target, okay? Targets is a personal thing based on preference. What isn't a personal thing is, one, why we enter, and two, where the risk is. Okay, the risk is known. The minute you know the risk in a trade, you've got to trade. Now, the last thing I'm going to say with leverage, I know a lot of you come from a retail background. Okay, now I never like to insult a retail background. Okay, but I like to just give the facts, be honest with you guys. Right now, how a retail background would typically work is you would have a candle, for instance. Something like that, and you would then get, the textbook would say you buy through the break there and you put the stop down there. Now, that type of strategy, swing strategy, whatever you want to call it, that sort of a type strategy is not going to work well with leverage. Why? Because, well, hang on a sec. Who can take a 40, 50, 60, tick stop? All right, not many people. Hedge funds, yes. Big macro funds, yes. They can take very wide stops. Day traders, retail traders with smaller accounts, we cannot take those kinds of stops. And more importantly, we shouldn't need to take those kind of stops, okay? So make sure when you're developing your strategy, develop your strategy based on, ultimately what your count is. Do you want to use leverage? Do you not want to use leverage? Okay, make sure you're not just picking up on certain things of Twitter and books and suddenly trying to employ them when you don't necessarily understand the full implications of it.
Hopefully now you really understand why liquidity is so crucial to professional traders. More importantly, how you can consider how you're going to utilize liquidity. We will touch on a little bit later in the strategy session on where you want to employ liquidity and some of the real key principles underlying the usage of liquidity. I think once you watch the strategy session, you're definitely going to be a lot more in the pro camp of liquidity rather than the anti-liquidity camp. So obviously this is now our final strategy. This is strategy number 10. This is the risk event trading section. Do note, these are counter trend strategies and momentum strategies in effect. And ultimately you will require a bit of context. I'll share some of that context with you within the strategy session. And note, you will sometimes need quite aggressive execution methodologies. But again, I will share that all with you in the strategy section. So you should notice, as you are all now professional pattern recognition experts, that every single one of the principles has been highlighted. The reason is simple. For risk event trading, obviously things speed up. Everything moves at a far greater speed. Now within that movement, okay, volatility effectively implies potential for opportunity. Now, because of that potential for opportunity, you're going to need to be switched on to every one of these principles. We've first introduced in Unit 3, but what we've consistently gone over throughout Units 6 to 15. So again, we are going to cover some really key principles here. Every one of them, in essence, will be key in one of the 3 patterns I'm going to show you in the strategy section. So last thing to say is enjoy the final strategy session. You know, this is going to be a lot of fun, this last one. You're really going to get a cool understanding of, you know, how markets move off of key events. And we're going to finish off by watching a really great video of the moment that Donald Trump was implicated by Flynn, and what the gold market did in that instance. Alright guys, good luck and enjoy the strategy session. So welcome then to the final strategy 10, risk event trading. Now obviously, as I mentioned in the previous slide, this is a contextual and footprint based strategy. But you're going to feel that it's a little bit different to some of the other strategies. And it is in many ways, and I'm going to explain to you why. Now, the first thing I just want to point out, obviously, you'll note that every one of the trading principles, as well as every one of the footprint principles, is now applicable on the concept of risk event trading. And the reason is that risk event trading, okay, the art of risk event, is in the word, okay? It's in the event that an unlikely risk, or it's in the unlikely event that an event occurs in which positions are now at risk, okay? That's in essence what risk event trading. In other words, risk event is nothing more other than outliers, okay? Some people call them black swans, some people call them outliers, some people call them whatever they want, okay? But in essence, it's where the markets are not correctly pricing the potential for that risk to occur. Now, again, I must note that obviously the concept of a black swan event is a very rare occurrence, okay? So it's almost a form of an extreme outlier. Right? Now, how it works, very simply, I'm going to explain it to you with a scale, and I'm going to move on to the next slide to show you this. So, if I was to illustrate how risk event trading effectively works, it all comes down to a scale. Right now, the higher the level of the risk, so the higher the risk, the higher or the greater the scope is for opportunity. And that's pretty much a great summary of risk event trading. So, as we go through this, just always keep this in the back of your mind, okay? The higher the risk, or the bigger the outlier, okay, or the less that a potential risk is priced by the market, the greater the opportunity is for you as a trader. Okay, the reason being, obviously, as the risk event enters the market, markets need to reprice relatively aggressively. Now, back in the day, I remember my mentor telling me about a situation where he was in the pits trading, and ultimately a German announcement came out from the Bundesbank, and it took a good 15-20 minutes for everyone to run back into the pits after having a couple of pints before they could take advantage of the new news, or the new fundamental news that had ultimately hit the wires. Now, that's changed, obviously, with systematic computers and algorithms. That's changed. Therefore, risk events do move the markets very, very quickly. They reprice themselves excessively quickly. Okay, so that's the first premise to understand. Now, before we move on and talk about some of the patterns that you're going to learn to recognize with risk events, I must come back to this concept of leverage, because it's not something that many people are willing to talk about, only because they don't understand leverage. Okay, that's why you don't hear many people talking about it now. What you might have heard or read about leverage, it's a bad thing. You blow up your account, etc., etc. Okay, I'm going to tell you that's rather infactual. Okay, I'm going to let you in on a little secret. Leverage is the only way. It's the only way to build an account. Okay. Now, a lot of you say, no, that's rubbish because I'm consistent and I'm building an account slowly. Yes, that's fair enough. You can build an account slowly, no doubt. Okay. And you can be profitable over the long run. But by build an account, I mean pay yourself in a manner that you can become highly successful and retire earlier. Okay, so what I want you to think of in terms of leverage is I want you to think of it in terms of risk. And I want you to ask yourself now and write this question down. How much risk, okay, how much risk would you be willing to take if I told you that the likelihood of an event occurring was 85%? Okay. Now all of you should be saying to yourselves, well, actually, if there's an 85% chance, I'm probably going to take slightly more risk. Okay, because it makes sense. There's a much higher probability for the outcome to occur. Now, the whole purpose of this course, the whole purpose of teaching you an objective approach and teaching you how to develop your own edge is to allow you to develop a process where you're finally going to begin to recognize certain A-plus strategies that give you an 85% probability of success. And when you recognize those, i.e. a successful breakout, i.e. a delta unwind, i.e. an elephant, a failed elephant. When you recognize those, that's when you need to learn to take on more risk, which is ultimately synonymous with take on more leverage. Okay, that's all leverage is, guys. Now, the biggest mistake people make when it comes to leverage is one, they don't necessarily understand leverage. But the second thing is where I went horribly wrong, is it's the execution methodology. Okay, so when we execute with leverage, obviously it's new territory, unfamiliar territory, uncomfortable territory, risking more than we used to. But ultimately, you need to execute in the same manner. Okay, so it's the same execution process. But here's a little tip I can give you. If you really want to be good, get good at it. For a start, get your feet wet. Okay, so apply it only to your A-star setups. Start off with applying it to, if it's only once a week, that one setup where guaranteed you can take 3 prices from the market. Okay, if you're used to using maybe let's call it a 5 lot, give it a go. Try a 10 lot. Try it. Okay, because you're going to have to get your feet wet at some time. That's the real art to leverage, is you have to start by getting your feet wet. Once you get your feet wet, what you're going to recognize is there's no difference between a 1, a 10, a 100. There is no difference. The market will take it all at the same price. Okay, obviously some markets are maybe a bit thinner. 100 lots might struggle at one price, but in essence, you'll be able to execute almost every strategy we've dealt with relative ease. Okay, so by getting your feet wet, you're going to recognize there is no difference. The last way in which you can learn to employ leverage, okay, and this is probably the most important one and the one that helped me, is learn to allocate capital. Okay, why? Because what we're afraid of when it comes to leverage is we're afraid of the unknown. Okay, we don't know what's going to happen, right? We don't know whether we're going to win or lose. It's something different. It's unfamiliar, so we're afraid. We get that pounding heartbeat in our chest, the unknown. So how do we eradicate the unknown? Well, it's very simple. We allocate capital. And this is a great rule of thumb. This is something I firmly believe in when it comes to wanting to learn the real skill of employing leverage. So you take your account. Let's say it's a $10,000 account. And you say to yourself, well, on a day-to-day basis, I need to give myself at least 20 days, 20 blowout days. Okay, that's, if you're a consistent trader, you shouldn't need more than 20 blowout days. And you say to yourself, by that definition, okay, I'm going to allocate 5% of my account, or $500, to today. And what you do is you come into the market, you recognize a trade that is an 85% probability, and you say to yourself, I've got a 3 tick stop. So the tick increment, let's say, is $30. Therefore, I can take 5 times 30, and I buy 15 lots, and what will be, will be. Whether I lose 500 or make 500, that's not important. The single most important lesson you will learn from adopting this process is why and how leveraging can be so immensely helpful in your career and get you onto that next level of your learning curve. Okay, so please understand that leverage is not something traders use every single day. Okay, they utilize it when and only when the odds of an outcome are stacked in their favor. Okay, so that's the real art to leverage. Hopefully you understand that now. Don't be afraid to employ that. Give it a crack. It definitely did help me a lot in my career. Now, let's talk a little bit about the 3 types of patterns you're going to see in risk event trading. Okay, so there's 3 patterns typically you'll see. Whenever you have risk events, these are the 3 patterns you're going to see now. The first is obviously what we call a trend. So the risk event occurs. Again, notice these risk events can be a central bank. Okay, it can be economic data. Again, key economic data. And even a market release. Okay, so something like earnings release or surprise earning release. So something that surprises the market wasn't expecting. Okay, now in this instance, the market can respond in 3 unique ways. The first is what we call a trend pattern. How this looks, market has the initial rally, quite aggressive, a lot of single prints, a lot of untraded area, illiquid, liquidity at a premium, very shallow pullback, hardly a response, more a little bit of profit taking from the algorithms, not really responsive sellers, before an extension and a secondary trend higher. That's the first pattern we're going to observe, and we will look at an example of that on the live examples. The second is called an initiative consolidation. So we get the initiative. Looks a little bit different to the first leg in example 1, in a sense that there's more liquidity on the way up. Okay, so this is the nuance. In the first example, there's very little liquidity, so low liquidity. Okay. In the second example, there's more liquidity, so the market has an initiative leg up. It runs into response. So responsive sellers, backs off, and we begin the process of just distributing. Okay, but we hold effectively the initiative. In this case, obviously the market can extend, right, or it can drop lower. But in general, this market's going to hold the bid for a lot longer than it's going to hold the offer. So again, a little bit more of a bias in terms of price towards the upside. The third is very simple. It's what we call an initiative. The fundamental hits, or the risk event hits, and the market reverses the entire thing and continues lower. And again, we are going to look at an example of this. Now, what I'm going to do is I'm going to come back to that initial example where we're talking about the bigger the risk event or the bigger the outlier, the greater the opportunity. Now, straight away, you should all be looking at this. And you should be saying to yourself, in the first example, if the market's going to trend, that's a very unique opportunity. Okay, why? Because if you're aggressive in this, the market's going to trend, and you can make a lot of money very quickly. Equally, you could probably, or not probably, you need to utilize liquidity, you need to utilize leverage in this situation because you know there's a high probability for trend number 1, consolidation, trend number 2. In the second example, again, there is a definite edge here. However, in this example, you might want to be aggressive initially, take some profits, allow the market to come back and try again. So in the second example, okay, the opportunity is still there, so an opportunity still exists, but it's slightly less than the first example. Okay, equally, the winners are smaller. Okay, the third example, again, this is one where you have to be very cautious. So in this example, the market extends, initiates one way, and then initiates in the opposite direction. Now again, you would have noticed in the previous unit, we did speak about a line in the sand. Obviously, with every single risk event, central bank, economic data, market releases, we always put a line in the sand. Because if we do get back below that red line on the same trading session, we will always get an unwind of the bias or a flush out of the delta positioning. So in the third example, we can see that opportunity, okay, I don't want to say it's smaller, but opportunity is almost non-existent. Okay, so this is what we would call typically a trader's market. So you have to really pay attention to every one of the principles you've learned to ultimately execute successfully in this third example. Now, the difference between every one of these three trade strategies is simply just the degree of outlier. It's the degree of black swan. Okay, so what do we mean by that? In other words, the less priced the market is for the information that it's received, the more likely it's going to move, like example 1. If it's already expected and priced and the market was anticipating it, it's going to move most likely like pattern number 3. And that's the key crux to it. The crux is to go and trade a number of data pieces, trade a number of central bank releases, economic releases, and learn to identify when these three patterns in play. Obviously, the attention we want to give and the energy and the focus is on the pattern that trend trends, because that's the one we've got the most opportunity. However, that being said, we can still take advantage of the opportunity in the second and third pattern, but we need to learn to identify very unique approaches to trading those. So let's go through those approaches now, and I'm going to show you where we'd execute on all three of the trade patterns. Now, the reason I love this trade strategy, okay, is because one of the mistakes I made very early in my career, and probably most of you make, you read something, whether it's the inflation report from Canada, maybe a central bank report, you maybe read the Financial Times or the Wall Street Journal, and what you recognize is, oh, this is really big data, this is a game changer. Okay, when in actual fact, what you're doing there is you're simply enforcing a bias from something you might have read. You're enforcing your understanding based on something you've read. Now before we look at the execution methodology, let's just go over one or two other principles to understand why does news or central bank news or market releases, why does it bring volatility? First and foremost, when we have these events, there is illiquid markets. Okay, in other words, liquidity becomes a premium, participants disappear out of the market. Okay, why would you take on risk when there's the potential for unknown? And the second reason why volatility comes is that as price shifts, in other words, as price moves up and down, remember, as we said, it brings in more and more participants. So the dynamic of price shifting brings in more participants. That being said, as I've said before, volatility, in theory, breeds volatility. Breeds. Okay, volatility leads to more volatility. Okay, another reason, uncertainty. This is the real key. Uncertainty means that people become less price sensitive. Okay, so when there's an unknown event or something that the market is concerned about, people don't think in terms of risk reward. They don't think in terms of anything other than, I'm not price sensitive, I need to just get the hell out and clear my book. Okay, and that's important to understand because, again, these are the underlying rules and principles that govern risk event trading. Okay, the markets will be illiquid, right? As prices shift, it's going to bring in more and more participants, different strategies, different players, exhaustion high, exhaustion low, trend. It'll bring more volatility because volatility breeds volatility. And obviously uncertainty means people are price insensitive, so you don't want to be fading certain risk events. Now, obviously note that one of the key tips I can give you for risk event trading is very simple. Okay, a lack of liquidity implies the footprint becomes more relevant. So less liquidity, okay, means that the footprint is a more valuable tool. Now you're probably scratching your head and thinking, why? Okay, well, it's simple. Less liquidity means that you are going to see and spot certain interactions a lot clearer. Okay, the color lines will be clearer. The interactions will be clearer. Okay, for example, a data piece comes out, the market moves up. You're going to know straight away what's happening at the high here, okay? Because you can look at the footprint. Is someone selling it? Is someone buying it? Okay, you just got to see a simple bit of absorption or color lines, okay, or color delta. Okay, and that's why, as a rule of thumb, and my tip for this strategy session, lack of liquidity implies the footprint becomes more valuable. So learn to utilize the footprint over economic data, market releases, and central banks. Now, before we get on to the actual examples as well as the live example, the last thing I want to talk about is context and preparation. Okay, now, if you followed the live trading that I do sometimes, you'll often see me trade over economic data. You'll see that I'm always extremely well prepared. Okay, by preparation, I mean fundamentally. Okay, so I know exactly what data piece is coming out. I know what the market's sensitive to. I know what the outliers are. And I create a certain strategy based on those fundamentals. Equally, I know the technical landscape. Okay, so I go and observe where are the key potential breakouts, where are the key levels, is there delta, is there some opportunity in terms of technical aspects. So I prepare extremely well, and that goes for every single risk event. Okay, if you want to become good at them, you can't just know the patterns. Okay, because the patterns will ultimately play out. But you have to be prepared to execute based on whichever pattern comes, and that boils down to preparation. Second to that, and the reason ultimately I highlighted every single one of the principles that we spoke about at the beginning of this strategy session, is that you're going to require every one of those principles to develop a contextual understanding. In other words, sometimes the market might go trend, and you might look at the data piece and go and say, oh wow, why did that go so high? It's not even a big data piece. Okay, but what you have to recognize is that the markets don't do what you think they should do. The markets don't always move like you think they should. Okay, it's not always necessarily a data piece that makes the market go trend. Sometimes it's simply the context or the nature of that market. Equally, sometimes Donald Trump might become president, and the whole world says that's going to create the biggest collapse in the global equity markets. And what ends up happening? It's the low of the year, and we've rallied 16-17% from that point. Okay, so again, the whole purpose of this entire course was to get you away from that a subjective thinking, that idea of regurgitating what the newspaper journalists say, and instead develop an approach based on the facts. Okay, and that's what the three patterns identify. And now I'm going to show you effectively how to ultimately execute on every one of those patterns. Okay, so the first one, trend is very simple. The key to this is you're obviously going to notice in the price action, price is going to move very aggressively. You're going to struggle to get in here. Okay, so you've got to be extremely aggressive, and you've got to execute in this first little bit of consolidation. Okay, this is where you want to be entering, and you're looking for that secondary move higher. Very simple in terms of stop. You can keep a really tight stop here. What I would say, if you have enough time to interpret the obviously the outlier, if it is massive, you can afford a slightly wider stop. Why? Because in essence, if they're offering you a better price, you actually want to be buying more. You don't want to be stopping out. Okay, so an example of a trend, yes, you do need to stop, but again, you can afford to be a little bit wider. Second example, initiative with a little bit of consolidation. Okay, in this example, again, we want to be a buyer on the way up, aggressively on the way up. Once the market does exhaust itself, back off, stand out, and again, try and initiate in front of, i.e., the low volume area or the imbalance. Okay, do note, once we take out this initial pullback zone, be very cautious. Why? Because we know through other units, once the market does re-enter that low volume area or that balanced area, it's likely to begin the process of filling out. Okay, so again, very logical stops, which we obviously created when we spoke about imbalance strategies. The last one, again, reversal one. This is where we protect ourselves. So once we get long, we do want to have a point where the market should not get below. That's why we always have a stop. It is to protect us in the event that the market does do a initiative reversal. What I would say, and this is where the whole concept of, again, being determined and not just giving up, okay, what this trade strategy does provide you with is, when we do take out that starting point, the loss that you incurred buying here and potentially being stopped here, you can make back by selling on the red line, okay, also known as our line in the sand, for a quick little washout of the fundamental bias in the market. Okay, those are our three strategy approaches. Now let's go and have a look and see what this looks like on the footprint charts, and then look at some practical examples. So in our first example, this is the UK CPI from December. It was on the 12th of December, and this is the pound sterling. It's a 5-minute rotation. Note the data came out here. Okay, so obviously what we're looking for at this point, we don't know which one of the three strategies is in play, but we do know how we want to execute based on whichever pattern the market shows us. Okay, so that allows us to be objective at all times and not enforce too much of an opinion on the market. Now note, market blipped up and we suddenly got quite a lot of absorption. So we could have been a buyer in this, assuming this was a potential for initiative and consolidation. We then got a new high, market pulled back. This is our gentle little clue. Okay, so we can see this does occur at the base of the selling that we received on the way up. And ultimately we can see again the buyers sat there just absorbing the market as well as buying. Once that got taken out, the market then did extend. So we were very easily able to recognize that this trade wasn't going to quite continue in a trend-like fashion, and potentially we were on for some form of a either more of a distribution type play or even a reversal type play. Now, the market ended up coming back into this imbalance, began the process of filling out, before then actually even not just getting below it, but then ultimately reversing. So this is the first example, like I was saying to you, in terms of reversal. What will always happen in reversal plays? Yes, you might lose money initially being a buyer higher up, which is fine, but don't forget that the market will always give you another opportunity, and if you switched on to it, you could have been a seller in this point looking for potential continuation. Okay. Also, if you weren't a seller at this point, a little bit of an inside candle here again gave you another opportunity before we had the very aggressive delta shift to the downside. Okay, so that's our first trade example. Our second example then is the gold. Now this is from the FOMC in December. Now note, obviously this is on the 13th of December, and again I haven't really got the numbers here. I want to focus more on the colors. Now note, obviously this was their hiked rates, remained with the idea that they're going to hike again 3 times next year. And what we can see is a lot of dark colors at the extremes and all over the show. So we can see dark pink, dark pink, dark pink, dark pink, dark blue, dark blue. Now, what's interesting about this is obviously, if we look in essence what the market did at the end, ultimately it did go higher. But what was one of the clue factors was all of the selling was being absorbed by buyers. In other words, markets came down prices, but ultimately the buyers won the net result, and we had a high volume surge. Okay, we can see it again in the next rotation. Look at the dark color. So all that selling, all that victory taking place from the sellers, but ultimately prices are starting to rise. Okay, we can eventually see, once all that absorption occurred, we started to see the buyers become more aggressive before ultimately moving prices higher. Okay, so that's a secondary example. Again, this is a little bit more of a blip up, consolidate. Okay, so straight away, no real tradable opportunity. And like I said, opportunity number 1, trend. There's a very straightforward tradable opportunity. Opportunity number 2, slightly less. Okay, more of a trader's market. Option number 3, very much a trader's market, which is pay attention to all the footprint principles you've learned and execute accordingly. Okay, don't forget, like we said, when prices move aggressively, it brings in a whole bunch of participants. Therefore, it's going to give you a whole bunch of opportunities. Okay, and that's why risk event trading is so important, not just for the footprint, but also for trading in general. Okay, the last example, again, this is now obviously, and that's the video we're going to watch. This was when Flynn said he was going to expose Trump. This is the gold market, 13th of December. Again, all I want to show you before we get to the video, look at the light shading. Some very aggressive selling being bought up, very aggressive buying. Okay, a little bit of a holding pattern, initiative again. So again, this is the key that we're interested in. Okay, that's a relatively strong move, like you'll see in a minute. Really strong impulse move. So we get the impulse move, a secondary impulse, a consolidation, and another impulse. Okay, so within that, it's relatively easy to execute and leverage yourself up. Okay, in terms of execution, like I said, we're looking for a really aggressive execution. Most traders would have been executing in here, potentially buying more and looking to run it up the page. Okay, let's now go and have a look at the example of this Flynn and see what it looks like on in the markets. Now, Obviously, it's quite aggressive, so do pay attention. But the first thing I want to bring to your attention is, remember, when these events come out, liquidity disappears and the market loses its head. Okay, so you have to be quite aggressive. You have to show intent. You have to be willing to be aggressive and leverage yourself up early. So we can see nothing's hit the wires yet. You'll notice the shift in the market. And obviously this was a data release on the 2nd of December in the gold market. Now note on the day also again, this is why it's so important to know the context. Note the delta, okay, really big negative delta for the gold, minus 3,300. Starting to see a pickup in volume. And ultimately, if we were aware of this before the number, you would have recognized that, if prices suddenly start to rise, we could very well see a delta unwind. And that's pretty much what you're going to see in the next couple of minutes. Okay, so the news is about to hit the wires. And I'm just going to move this on a little bit. So the news is hit the wire. So we can see an initial imbalance, not a great deal of volume. This is what I was saying to you. Where the footprint is so great, because liquidity disappears, look how obvious we can see the orders. Okay, so look at the standout buy here. Okay, that's not even a big participant. Remember, big influential participants don't have footprints. Okay, they'll be hearing this news a lot later than most. These are simply algorithms. Okay, so look at these orders. Look at this dark blue, dark blue, dark blue. Okay, so we can really see something has shifted the nature of the market. Now everyone's starting to pick up. Now we're starting to see the market really take off. So again, in this first bit, you can really clearly see how the footprint gives you an extreme advantage. Again, note, what are we seeing here? Look at the high here. Yes, we're seeing selling. Okay, what are we seeing? All that selling being absorbed. Equally, selling being absorbed and buying and buying. So we're seeing selling being absorbed at the extreme of the day and more buying. Okay, again, very useful if you've got a footprint tool. If you don't, you can't quite see this as easily. Okay, now obviously, if we didn't get in on these dark blue colors, we definitely wanted to be in on this absorption lower down, looking for that extension, looking for that continuation. Now, again, obviously, we do get a little bit of a blip up in the markets. We run into a little bit of responsive selling. So this is that sideways bit of trade that you saw, maybe a little bit of profit taking. Note, when you get trend, it's very unlikely that there's new positioning. It's simply just a bit of responsive price action, probably a little bit of profit taking, maybe a little bit of speculative shorts, just trying to take a couple of increments after we've seen, notice the exhaustion high. Okay, so the market just takes a little break after the exhaustion high before continuing high. Again, notice the footprint. Okay, look at the colors at the extreme there. Really, really large buying. Buyers holding the market quite aggressively high. Note delta, still minus 2,000. So we know that, price is moving higher. This delta still has room to unwind. And that's what we're going to ultimately see here. We're going to see this keep moving higher. Again, notice the imbalance on the next leg higher after that. Very aggressive buying at the high. Note again, very aggressive buying at the high. So this is a real characteristic of trend. The market does tend to hold at the extreme. Really forces you into the extreme if you do want to partake. And that's the real edge behind this trade, is to be aggressive. Okay, obviously it does extend. You can obviously watch this in your own time. And eventually the market does form a top and settle down. Note again, the top formed on an exhaustion high, also with an imbalance just before the exhaustion high. Okay, so that's the gold example then. And our second example will be in the euro. This is the euro CPI. And this is a little bit more of a mundane, boring type risk event. But again, it goes to show that there are tradable opportunities. So I'm just going to show you this. Obviously, we have received the European CPI data. Okay, we can see that the market, let me fast forward back a little bit. Okay, so we can see the data's come out. The market is taking this quite negatively. And we can see, obviously, market blips down, quite a lot of selling. Okay, notice all the red, very aggressive selling all the way down. Price moving in the direction. Again, probably no real great opportunity to get in. It was far too quick. So what we're looking for, obviously, in this instance, maybe the first pullback for a tradable opportunity. Otherwise, we rather just stay out. The market comes back. Notice fills in the first of the imbalances, trades and absorbs 102 before offering back down to the low. So that would have been our potential trade opportunity on this risk event. And ultimately then the market begins the process of distributing within the lower bounds. Okay, those are two examples. Obviously, we will have two more examples of risk events in the drill section. Let's now go and complete our final template. And I really hope you've enjoyed these practical sessions on the board. Do remember, obviously, you can go watch every one of these videos again. I've just tried to highlight for you, the key sort of standouts from the footprint, where the footprint is extremely useful within each one of these strategies. complete the last of our templates. Don't let it end here, guys. I think that's the big hope here. I hope this isn't the end of your template, your templating habit. I can guarantee you, if you continue on the path of completing these templates, you continue to develop your own templates, maybe utilizing mine as a base, you will develop some incredible insight and ultimately consistency and pattern recognition within your trading. That being said, let's finish our final strategy session. Again, market context. Obviously, note we spoke about 3 different patterns: the trend, the initiative met by responsive, as well as the initiative reversal. So again, all of them will have their own sort of trending and consolidation phases. And again, when you draw out your pattern, make sure you're drawing out if it was a trend. Did I see trend? Was there too much response in the trend? Those are the kind of things you want to pay attention to. Then in terms of obviously balanced and imbalanced, again, imbalanced markets will have a higher potential to be volatile. Now, one of the key takeaways from all 3 of these strategies that I showed you was that market context is imperative to the way the market moves. Okay, a lot of the time we might get something which we think is big, and it might go in the opposite direction. Okay, we left there scratching our heads and being subjective rather than paying attention to what the market's telling us, which was there was something bigger at play. Okay, and that's why we acknowledge before a session, before a key event, we always want to be well prepared to know the context of the market. So in balanced markets, okay, contextually, they can move a lot more directionally in a trend-like fashion than, say, a balanced market. In terms of trade location, obviously, we can find these risk events at the extremes, mid-range, but the most important thing is to identify, again, all the contexts. Okay, where were we trading? Were we trading in extreme? Were there key technical levels? Was there a key breakout? Were we in the middle of the range? Were we balanced? Were we imbalanced? What I want you to do is draw the strategy first. Which one of the 3 patterns did you identify? And then come back and outline what was the market context around that pattern. Because what you're going to start to see is that in a trend, more often than not, it's going to be trending, it's going to be imbalanced, and it's going to be at the extremes. And that's the kind of patterns you want to develop. You want to develop what does the pattern look like versus what are the objective facts that the markets are showing me based on that pattern outcome. Okay, market conditioning. Again, note, we want to talk a lot about the time frame participants here. Influential, are they in? The algos and the speculative, where do they enter? How do they enter? Don't forget, obviously, algorithmic and speculative are a lot quicker than the institutions, so they will jump onto certain things a lot quicker, which is also why, as you will recognize, over data pieces, the market and the order book goes thin, and you don't get a great deal of volume going through. Okay, it's simply just automated strategies rather than institutional large time frame participants. In terms of liquidity then, note, again, you want to talk about, where's the high liquidity, where's the low liquidity, what does the market do once it finds the liquidity based on the pattern you've recognized. And lastly, obviously, volatility. Again, where there should always be high volatility in theory, but how quickly does that volatility disappear? Where does it disappear? Why does it disappear? Etc, etc. So again, really elaborate on all these key identifiers within the template, and make sure that you understand what ultimately is creating the observable pattern. Okay, let's now move on then to the strategy identification part of the template. So again, really key is interaction. When you look over these patterns, again, focus on the interaction. Like I said, the footprint tool is unique for risk events because less participants, you're going to very quickly see the interaction a lot quicker on the footprint. So make sure you adopt this tool into your risk event trading. It will definitely add some real value. So again, I'm not going to go through any great deal initiative responsive. We've gone through this quite extensively, but there you have it. Obviously, it's the 3 different patterns: trend. Obviously, it's initiative. With the second of the patterns, trend balance, it's initiative and responsive. With the third of the patterns, reversal, it's initiative. So again, make sure you're identifying the initiative and responsive price action. What does it look like, and how can you identify it in the future? Then in terms of passive-aggressive, again, identify the nature of the interaction. Is it passive-aggressive? Where is it passive? Why is it passive? Why is it aggressive? Okay, in terms of the metrics, again, we pay attention to all of these metrics. Volume, time, delta, cumulative delta, and relative change. Every one of these metrics will be or will show a unique set of trace compared to every one of the strategies. Okay, trend, you will always have high volume. You'll always have very shallow pullbacks, and it'll happen very quickly in terms of time. The delta will always be incredibly strong in the direction of the trend. The cumulative delta will race up in terms of the trend, and the relative change will be very aggressive. Okay, those 5 principles will always be evident in a trend move. Okay, and that's the key, is when you see those 5 elements, that's when you want to be aggressively executing. That's when you want to be employing your leverage and taking advantage of the opportunity the market's gifting you with. Okay, let's now turn our attention to our final part of our template, the execution. So the key from the execution is that you're going to need to learn to be a little bit uncomfortable. Okay, you have to be quite aggressive in terms of execution with risk events. Now, a way to get through this, and this is the best way to understand this, is that with these risk events, there is the potential for much greater reward. Okay, the hardest part about these events is knowing the difference between what has got potentially big reward and what doesn't. Okay, if you can identify high probability opportunities, the trade strategy execution is relatively straightforward. Equally, if you know there's a very high probability of price to go up or down, ultimately the execution is straightforward in the sense that 1, you can get in aggressively. 2, you can be a relatively looser, well, not looser, but you can have slightly wider stops simply because you're going to get much greater reward opportunities. Okay, again, opportunity, it all depends on context. It all depends on that preparation you did beforehand. A market that's imbalanced, much greater opportunity. A market that's relatively balanced, again, has great potential for reversal opportunity. In terms of risk reward, again, every one of these has got great potential risk reward, so long as you identify what ultimately is a good risk event with good opportunity. Application wise, it's very exact, not a great deal. You don't need to obviously be not necessarily smart, but you just look for those identifiers, a little bit of absorption, those key little signals, and you enter on what the footprint is showing you rather than what you think. In terms of leverage, with the big outliers, as I mentioned, with big opportunity, we can take great leverage. Why? Because the odds are very heavily stacked in our favor. Our tip, and my final tip for the not just the course, but for this strategy 10, preparation is the key to successful execution. Okay, that's not just for the strategy, that's for everything. Okay, not just trading, for life as well. Be prepared before every risk event, because that preparation will pay you. All it takes is one outlier opportunity that you execute with leverage, and you can make more money than you've made in 6 months in a couple of moments. All right, guys, let's now move on to my final suggested reading. Hands down, my favorite book, my book of 2017. It came out, I think, in August of 2017. Matthew Syed, Black Box Thinking. The title gives it away. The same author as Bounce. Okay, great book as well if you haven't read it. Quite old Bounce, been around for a couple of years. Summary: Edge is developed through smart open loop processes. Okay, you probably would have heard me giving you a couple of these ideas. They aren't my own ideas. They were ideas that I have now not just adopted from Matthew Syed, but I've actually gone and reinforced them and really recreated them for myself. So a great book. The action it's going to require, or that it's going to promote, is philosophy shifting. It's really going to make you think differently, and that's why this is my number one pick. It's extremely thought-provoking and will prompt some sort of a mindset shift. Some of the key highlights: understanding of cognitive dissonance. Fantastic concepts. Closed loop thinking as well as marginal gains with the use of practical examples. This is what I really liked about it. Not only did he introduce these concepts where most people get lost and they kind of get bored very quickly, but then he applies these concepts and you really grasp the concepts through the examples, and that's why I think it's such an effective read. Note, he speaks heavily of the importance of growth through failure. Again, that's what this entire course has been about. It's been about, this bottom-up approach of failing. That's why we do the templates, because the templates reflect our failures. And through the templates, we see the failures. And only when we see the failures can we then find solutions and adopt a better process until we get to the ultimate process. That's what this entire template function is ultimately about. A fact-based overview of some of the most relevant principles driving innovation and thought in the 21st century, and also how creative thinking comes about, which is a really good chapter as well. Probably something not many of you might have thought about. And lastly, the secrets and understanding to high performance. Trading is a high performance industry. It wasn't always, it is now. You're up against some of the smartest, fastest, most creative, biggest pockets. Don't forget, you are a small fish in a relatively large pond. So am I. So what we have to do is we have to learn to perform at a really high performance. Fantastic book, great read, highly recommended. Let's go wrap up now, Unit 15. This is then the final drill session. Again, I'm not going to go through this. You've been through this enough times. You should be in the habit of knowing exactly what I'm going to say anyways. But in case you've forgotten, go through the drill. Complete the template, make sure you're accountable. Have one last check now. Go back to your first template you completed, back on day, I think it was maybe day 10 or 9, somewhere around there. Go back and have a look how long that first template took you to complete. Compare it to how long it took you to complete this template. You should note a significant difference. Also have a look how much writing you've got on the first template versus how much you've got now. Okay, that's a reflection of the hard work you've done. That's a reflection of everything you've achieved through following the process of completing a template. Don't forget, you've achieved something remarkable. If you have followed the day-to-day challenge, congratulations, that's brilliant. If you have completed a template at the end of every drill, you are a superstar. Well done. Now, once you've done obviously with that final template, go through the guided tuition. You can then obviously go and view some of the examples we utilized within the unit. You can then complete again, or not you can, you should complete another template. Once you're comfortable, you're not going to move on to the next unit because that is the end then of the course. Let's now move on to our final thought slide, where I'll leave you with a closing message. So that brings us then to the final thoughts of the Footprint course. Firstly, congratulations. It's a fantastic achievement to get to the end of this 30-day challenge. It's not been easy. I know a lot of you have got full-time jobs, full-time careers, you're full-time parents, but congratulations on one, taking the step, but two, completing and pretty much finishing what you've started. Now, if you don't necessarily want to adopt any of the 10 strategies, that's okay. But hopefully you've learned something unique along the way, because there's been so many fantastic principles we've covered, as well as so many unique strategies that don't necessarily act as standalone strategies, but can act as other guides to the way the markets are moving and potential targets, etc., etc. So I really want to thank you for taking the course. Now, some of the most key elements, like the checklist we had obviously in Unit 1, this is my checklist in closing. I really want to ensure that you've moved away from a subjective understanding of the market, that I think it's going down, I think it's going up, I want to buy, I want to sell, this is a good level. If you find yourself saying any of those things still, go back onto some of those key strategy sessions and really look into the real objective approach and process we've adopted. By now, you should all be looking at the market and saying, I've noticed some facts in the market. That means there's a potential for a breakout strategy. That's how you need to be looking at the markets. Remove yourself from the subjective approach and become a professional and focus on the facts in the market. Secondly, develop a growth mindset. Okay, this is what this whole course has been about. It's been about failures, but learning from those failures. Okay, every one of my trade strategies, every one of my successes has come from failure. Okay, I was no different to any one of you. I started trading in 2011. I failed many times. I've been at a zero account. I've wiped out a really big account. I've done all the failures. Okay, some of you might be there right now, and you might be at different stages of your career. But ultimately, the beautiful part about having those failures is I know where I've been and I know where I am now. So don't be afraid to fail. Okay, failure is important to ultimately get to success. Understand the principles that govern price movements. This is crucial. Okay, prices don't go up or down because of the tool. Right? The footprint is not the holy grail. It isn't. Okay, it's not going to make you profitable. It's not going to put pounds in your bank account. The footprint is going to allow you to view the interaction taking place between buyers and sellers. That is the purpose of the tool. Your goal is to develop a strategy-based approach and extract information from this tool to give you that understanding and confirmation that it's time to execute. Don't forget that. Then fourth, develop strong process habits with template completion and creation. Don't stop with this template. You've done such a remarkable job. Redevelop it, add to it, adjust it, do whatever you want, but make sure you keep templating. Make sure you keep stenciling, how you're executing, how you're viewing the markets against what the markets are showing you. That way, you're going to develop a very strong process of ultimately recognizing and executing patterns. Now, obviously, you've got 10 patterns. You don't have to adopt them all. You can adopt one. That's fine. You can adopt one variation within one pattern. You can adopt them all. My suggestion, less is better. Adopt what makes sense to you characteristically. If you're someone that likes momentum, don't bother with counter trend strategies. Focus on the breakouts. Focus on the initiative imbalances. Focus on things that make sense to you characteristically. All right. Apply those strategies. Most importantly, then, as you begin to develop those strategies, you have to keep adopting them and ultimately adapting them. Okay, you can't stay stagnant in this job. Those strategies will change, and so do you need to. Then in terms of obviously, all those strategies do appear on a daily basis across different markets. Obviously I utilize all 10 of the strategies across different markets, so I know. And as you'll see now when we finally get to the bonus material, we even applied it to Bitcoin on a wonderful day in December. I think we got 4 or 5 different of the footprint strategies all in a 4 or 5 hour time session. So it was really great to see that the footprint can really be nicely applied to even the Bitcoin market. Lastly, don't be afraid to lean on your peer-to-peer group. Okay, it's there for you to share ideas. It's there for you to learn and ultimately grow. Alright guys, that then brings us to the end of the footprint course, and I want to finish with a quote. I think that's probably the most effective way to summarize this entire course. It comes from the master again, Paul Tudor Jones himself. The real growth comes from handling the uncomfortable process. Okay, be willing to fail. If you're willing to fail, you will grow. Thank you very much, and I look forward to seeing you guys in the peer-to-peer group. So welcome then to the final of our drill sessions. This is Strategy 10 Unit 15, which is all about risk events. And I did show you two really cool risk events. One was obviously the Trump-Flynn saga, and that was and then obviously the Euro CPI. And I think the gist of these risk events and the real key takeaway that hopefully you all picked up on is that it's all about preparation. Okay, every single thing comes down to preparation. You need to prepare the context of your market. You need to have a good understanding of where your market is trading going into that risk event. Okay. If I was to summarize what a risk event is, in essence, it forces participants to respond and react quicker than they normally would have. Why? Because the data or the announcement or whatever it might be pushes prices to a point where a lot more participants have to respond. And that's what you have to recognize. Okay, these risk events bring opportunities simply because they force the strategies to come a lot quicker than they would have otherwise without the data. What we're going to look at, it is the UK inflation data in December. It was expected to come out at 3%, and it actually came out 0.1 lower than expected. Now, it was important simply because of where the Bank of England's stance was. There was that obviously just recently hiked, and the market was trying to figure out when that next potential rate hike could come. Now, the important thing is we're going to play this through, and all I want to just reference, the reason why the footprint is so fantastic for risk event trading is simply because the less participants in the market and the less liquidity, the easier it is to ultimately see and pick up when that first bit of absorption actually comes into the market. So again, what we're going to see, we're going to talk us through, we're going to ultimately see that fast money move down. Again, very unlikely that you're ever going to be able to partake in this simply because it would need to be a real outlier. So we said in order to be aggressive, in order to get those trend type moves, you would require a real strong piece of outlier information. So in this example, I would say anything 0.2 or 0.3 of a miss would have been an outlier. Obviously, it only came out as a 0.1 outlier. Okay, so again, bang, we hear the number comes up 0.1, and we see the initial reaction. Very quick, 50 tick blip, no real opportunity to get involved there. Okay, we did obviously, however, recognize that the first pullback is always quite crucial. So what we're looking at on this footprint on the right side is we're looking for that first bit of absorption. So we're looking for absorption, a seller to absorb as well as sell at the same time. The moment we see that, we're going to try and enter on the short side and try and look for a retest of the lows. Okay, so the market comes back bid. Note what we're seeing: 15 lots, 6 lots, 9 lots, 22. Not a great deal traded there. The top was 04s. Now again, remember, obviously liquidity is still very much at a premium. That's why the markets are so thin. So to safeguard ourselves, we do want to see a little more absorption, and there we can see it. Okay, notice straight away what's coming in. 111. What are we seeing? Absorbing on the offer, but equally selling at the best bid. Okay, so there's our absorption taking place. We now enter our trade. We want to enter at the 00s, at the 01s, where that absorption took place, looking for a retest of the lows and potentially an extension. Again, note a little bit of absorption there. 58 contracts trade again, side by side where that absorption was. Okay, so really good example of how you can see nothing going on, and suddenly the footprint can really highlight where that absorption comes in on the first pullback. Okay, the market then obviously starts to offer, and this is quite crucial. When the market has identified that volume pocket or that absorption, it will tend to offer very quickly down again, simply because of how thin the market is. We can see it on the candlestick as well. Do note, obviously, still relatively okay volume on that rotation, good delta in relative terms. But again, this is where coming, and assessing the data is crucial. Had this number been a 0.2 miss, we would have had a much higher probability of extending lower than if it was just a 0.1 miss as we got. Okay, so the market then obviously forms a little inside candle. We do get a little extension, a little test of the previous low. Market double bottoms, and straight away we begin to auction back higher. Okay, the market then goes, and I mean, most of you have been through this example now. It does come back up. It retests that point of exhaustion, or the absorption that we identified, and then offers back down again. Now, I don't really want to, go over too much more in this video, simply because, we've identified what the real key element to risk event trading is. It's about, number one, making sure you know what the outliers are versus what's expected. Okay, you create the binary. That's the real key to getting good at this strategy. You create the binary in your head. It either does A and you execute A, or it does B and you execute B. Okay, it's as simple as that. Once you have an understanding of what those outliers are, you simply just understand the context in which your market is. Okay, where are the key support and resistance? Where are the key pinch points in the market? Are there some ledges? Is this market likely to be aggressive because it's imbalanced, or is it likely to be balanced? And you really just break down the preparation so that when the market responds and it suddenly moves, you simply just executing. Okay, that's a wrap. Go back to those templates, update those templates, make some changes and adjustments. Go through the other risk events. Okay, we had 2 other really key risk events. They are available for you there. And thank you very much for this drill session and joining in for this last drill session. I do wish you all the best in your careers. Keep practicing, keep working hard, and I'll see you guys in the chat rooms.